I want to show you something. This is what $10,000 looks like after 30 years in an S&P 500 index fund. No trading, no watching the market, no finance degree, just $10,000 put in and left completely alone, $76,000. 7 times your money, from doing nothing, from understanding one concept and making one decision. Index funds are the single most powerful wealth-building tool available to regular people. Warren Buffett has said repeatedly that a simple S&P 500 index fund is the smartest investment. And yet most people who hear the words index fund either glaze over or assume it's something complicated that they need to understand better before they can start. Today we are ending that completely. By the end of this video, you will understand exactly what an index fund is, why it beats pros, and which ones are worth knowing. Let's go. Before we get to index funds, I need to make sure we have the foundation right. So I'm going to start from the very beginning. Stay with me. When a company wants to raise money to grow, one of the things it can do is sell small pieces of ownership in itself to the public. Those pieces are called shares or stocks. When you buy a share, you own a tiny fraction. If the company grows, your share becomes worth more. If it struggles, your share loses value. Buying individual stocks is essentially making a bet that one specific company is going to do well. And that is genuinely hard to get right, even for professionals. About 90% of actively managed funds, run by highly paid experts whose entire job is to pick the right stocks, fail to beat the market average over a 15-year period. So here's the question that changed investing for a lot of people. Instead of trying to pick the winners, what if you just bought everything? That's the entire idea behind index funds. Instead of betting on one horse, you own the whole race. To understand an index fund, you first need to understand what an index is. A stock market index is simply a list of companies used to measure performance. The most famous one is the S&P 500. It's a list of the 500 largest publicly traded companies in the United States: Apple, Microsoft, Amazon, and Google. Berkshire Hathaway, Johnson & Johnson. 500 of the biggest, most established companies in the American economy, all in one list. When people say the market is up today, they usually mean the S&P 500 is up. It's the most widely used measure of how the stock market is doing overall. Now, an index fund is a fund, a collection of investments, that is designed to mirror a specific index. It buys pieces of all 500 companies in the index. When you invest in an S&P 500 index fund, you effectively own a tiny sliver of 500 of the largest companies in America. Your investment rises and falls with them. Here's the part that surprises most people. Index funds don't just do okay, they beat most actively managed funds run by highly educated professional investors. How is that possible? 2 reasons: fees and consistency. Actively managed funds employ analysts and managers to research companies and constantly trade. That costs money. The fees on actively managed funds, called expense ratios, typically range from 0.5 to 1.5% per year. Index funds charge almost nothing. That might sound like a small difference. Over decades, it's enormous. On $10,000, you could pay $15,000 in fees instead of $500. Now let me tell you about the bet. In 2007, Warren Buffett publicly challenged the entire hedge fund industry to a bet. He said a low-cost index fund would win. The results after 10 years were not close. The 5 hedge funds averaged a 2.96% return. Buffett's index fund returned 7.1% annually. Buffett's conclusion is that for most people, a low-cost S&P 500 index fund is the single best long-term investment they can make because it's reliable and cheap. Let me show you what investing in an index fund actually looks like over time. These numbers use a 7% average annual return, the historical average. If you start with $10,000, after 10 years at 7%, you have nearly $20,000. Your money has doubled. But look what happens after 30 years. That same $10,000 becomes $76,000. That is the magic of compound growth. $200 a month invested for 40 years becomes over $500,000 from $200 a month. That is life-changing. The most important variable isn't how much you invest, it's time. Starting at $25 with $100 a month beats starting at $45 with $300. I'm telling you this so that today, not tomorrow, feels like the most important day to start. Every year you wait is compound growth you can never get back. Before I show you which funds to know, I need to explain the expense ratio. It's the annual fee a fund charges, expressed as a percentage of your investment. It comes out automatically. You never write a check for it. It's just deducted from your returns. On $10,000, a 1% ratio costs $100 a year. A 0.03% ratio costs you just $3. When you are comparing index funds, lower is always better. Every penny matters. Now, 3 funds worth knowing. I'm giving you clarity so you can make the decision yourself based on your brokerage and your situation. First is VOO from Vanguard. It tracks the S&P 500, the 500 largest US companies. It's extremely popular and very low cost. Next is VTI. This is broader. It holds essentially the entire US stock market, including thousands of smaller companies for more diversification. Third is FXAIX. This is Fidelity's version of the S&P 500 fund. It has a tiny 0.015% fee, one of the lowest in the world. If you're at Fidelity, look at FXAIX. If you're at Vanguard or Schwab, look at VOO or VTI. They are all excellent starting points for your journey. I have to be straight with you. Index funds are not risk-free. The market goes down, sometimes significantly. We've seen drops of 30 to 40%. In 2008, it dropped nearly 40%. In 2020, it dropped 34%. But after every single drop, the market has recovered and gone on to new highs. Stay invested through the dips. Time in the market is far more important than trying to time the market by guessing when to buy and sell. The investors who got hurt worst in 2008 were the ones who panicked and sold at the bottom. Those who stayed in fully recovered within 4 years. Index fund investing works over long time horizons, 10 years minimum, ideally 20 or 30. This is money you can leave alone to grow. Here's how to actually buy an index fund. Step 1, open a brokerage account. You can do it in about 15 minutes online with 0 account minimums. Step 2, decide on the account type. A Roth IRA is incredible for retirement tax advantages. Otherwise, a regular taxable brokerage account works fine. Step 3, fund the account. Transfer money from your bank. This usually takes 1 to 3 days. Start with whatever you have, even a small amount. Step 4, search for the ticker symbol, VO, VTI, or FXAIX. Buy however many shares or fractional shares your budget allows. No minimum required. Step 5, set up automatic contributions. Even $50 a month on payday is how wealth is built. Consistency over a long time is the secret. You now know more about index funds than most adults. This is wealth-changing information when you understand it early enough to act on it. In the next video, I'll show you exactly how to start with less than $100, walking through opening an account from scratch. Don't miss it. The chart at the beginning, that could be your money. It just requires starting and staying consistent. I'm Clara. This is ClearEst. Go understand your money. Now, I want to take a moment to look deeper into how these indexes are actually weighted and why that matters for your portfolio stability. Most index funds use market cap weighting. This means the largest companies make up a larger percentage of the fund. It follows the winners automatically. The index is self-cleansing. If a company fails, it drops out. If a new company rises, it gets added. You never have to pick the new winners yourself. You're also diversified across sectors. Tech might be down, but healthcare or energy might be up. The S&P 500 covers almost every part of the economy. This is what we call passive investing. You aren't trying to outsmart the market, you're just capturing the long-term growth of the entire system. One of the biggest hurdles in investing is emotion. Index funds take the guesswork out, making it much easier to stay the course when things get volatile. Most index funds also pay dividends. When you reinvest those dividends automatically, your compound growth accelerates even faster over time. Index funds are also very tax efficient. Because they don't trade often, they don't trigger as many capital gains taxes as actively managed funds do. While we focused on the US, there are also international index funds. Owning the whole world stock market is the ultimate level of diversification. VTI is great for this. It gives you exposure to smaller, fast-growing companies that aren't yet in the S&P 500 but might be the giants of tomorrow. The fund managers handle all the rebalancing. You don't have to worry about selling winners or buying losers to keep your portfolio on track. We owe this all to John Bogle. He created the first index fund for individual investors and fought the industry to keep costs low for everyone. Vanguard is unique because it's owned by the people who invest in its funds. Their only goal is to lower costs for you, not make profits for shareholders. You'll see index funds as ETFs or mutual funds. For most people, ETFs like VO or VTI are easier because they have no minimum investment requirements. And thanks to fractional shares, you can start with as little as $1. You don't need $500 just to buy one share of an S&P fund. Remember, the 7% return we talked about accounts for inflation. In nominal terms, the market has actually returned about 10% annually. Bear markets, when the market drops 20% or more, are a normal part of the cycle. They happen every few years. Expect them. Don't fear them. The stock market is not the economy. It often recovers well before the economy does. This is why staying invested is better than waiting for good news. Volatility is the price you pay for long-term returns. If you can handle the temporary ups and downs, the permanent growth is your reward. The best way to invest is dollar cost averaging. You buy the same amount every month. When prices are low, you get more shares. When high, you get fewer. This is the set and forget strategy. It removes the stress of trying to find the right time to buy. The right time is simply whenever you have the money. Let's revisit fees one more time. On $100,000, a 1% fee can cost you $130,000 in lost growth over 30 years. That is a massive amount of wealth being transferred from your pocket to the fund managers. Low-cost index funds keep that money working for you. Some people think they need more than 500 companies. For most of us, the S&P 500 provides all the diversification we really need to build wealth. Index funds benefit from survivorship bias. They naturally hold more of the companies that are winning and less of those that are failing. It's built in. Don't let the simplicity fool you. In investing, simple is usually better. Complicated strategies usually just lead to more fees and more mistakes. Before you jump in, make sure you have an emergency fund. You don't want to be forced to sell your index funds during a market crash to pay for a car repair. If you have high-interest debt, like credit cards, pay that off first. The return on paying off a 20% credit card is much higher than any fund. So here is your plan. Open that account. Pick a fund like VOO or VTI. Set up an automatic transfer. Even $50 a month makes a difference. Think in decades, not days. Check your account once a year, not once a day. Your job is to let time and compound growth do the heavy lifting for you. You are ready. You have the knowledge, you have the tools. The only thing left is to take that first step and get your money working for you. I want to hear from you. Which index fund are you looking at? Drop a comment below and let's start a conversation about our wealth building journeys. If this video was helpful, please hit that like button and subscribe. It helps me reach more people with this life-changing financial education. Thank you. Remember that number, $76,000? It's waiting for you. All it takes is the decision to start today. I'm Clara. This is FXAIX. Go understand your money. I'll see you in the next video where we start your first $100 investment together. Goodbye for now. Check out my other videos on budgeting and debt management to build a solid foundation for your index fund investing journey. See you there.